Welcome to This Explainer. Today, we've got a mission that is straightforward but absolutely vital. We are demystifying the most famous, most widely used, and honestly, probably the most misunderstood metric in all of finance. We're talking about the price to earnings, or PE, ratio. So is the low PE always a bargain? It's this deeply held belief among a lot of retail investors that a low number automatically means a stock is cheap and a high number means it's just too expensive. But if you walk away with nothing else today, understand this. That assumption can be incredibly dangerous to your portfolio. Okay, let's dive into this. Like this quote from the Everything Money Analysis perfectly captures, this so-called golden key to investing can actually fool you. A low PE might just mean a company is, well, a sinking ship, while a high PE could actually represent the deal of a lifetime. Today, we're going to figure out how to tell the difference. Here is our roadmap for today. First, decoding the PE ratio. Second, the growth factor. Third, ROIC, the hidden engine. Fourth, the Shiller PE and zooming out. And fifth, putting it all together. All right, part one, decoding the PE ratio, the surface level of valuation. Before we get into the heavy corporate finance stuff, let's just establish the absolute basics. The foundational math is incredibly simple. The PE ratio is literally just the stock's price divided by its earnings per share. Or, if you prefer looking at the whole pie, it's the total market cap divided by the total net income. It answers one fundamental question for us. How many dollars am I paying today for each dollar this company earns? And this brilliantly illustrates the concept in the real world. Think about a massive company like Apple. If it has a $3 trillion market cap and generates $97 billion in net income, you just divide $3 trillion by $97 billion. That gives you a PE ratio of roughly 31, meaning you are paying $31 for every $1 of Apple's current profit. But right away, we kind of hit a fork in the road here. Which earnings do we use? The trailing PE uses the last 12 months of actual historical earnings. It's super reliable, but, it looks backwards. The forward PE, on the other hand, uses Wall Street's projected future earnings. It looks ahead, sure, but it relies on optimistic and sometimes flawed estimates. Moving on to section 2, the growth factor, and why a low PE can actually be a trap. So why is it that two companies trading at the exact same PE ratio are rarely valued equally? Well, it all comes down to speed. Just compare company A to company B here. Both have $10 in earnings and a PE of 15. On the surface, they look identically priced, right? But company A grows at 5% a year, while company B grows at an incredible 20%. Look at what happens in 10 years. Company A is making about $16 a share, but company B is making $80. Paying a premium for company B's compounding growth is clearly the smarter move. A flat PE ratio is totally blind to this. Real history totally backs this up. Look at Microsoft around 2010. The market's perception was just terrible at the time, and the stock's PE plummeted to 8. It looked like a dying company. But the reality was, revenue was still growing at 7 to 8%, and profits were growing at 10%. That low PE wasn't a warning sign. It was actually a massive mispricing and a huge buying opportunity for a steadily growing giant. Now, flip that and look at Nvidia back in 2020, trading around $10 a share but only making 12 cents in earnings. It had an absurd PE ratio of over 80. A strict value investor would have run away screaming, but because of the unforeseen, massive revenue growth from the AI supercycle, that supposedly expensive stock was actually an incredible steal. And this is exactly why growth-focused investors swear by the PEG ratio. By dividing the PE ratio by the annual earnings growth rate, you normalize the valuation. It answers a really crucial question. Am I paying a fair price for this company's speed? If you have a PE of 30, but the company is growing at 30% a year, your PEG is 1.0. Which means that lightning-fast growth might actually justify the high sticker price. All right, section 3, ROIC, the hidden engine and the source of free cash flow. To understand exactly where that growth actually comes from, we have to go deeper into the engine room. Let's borrow this brilliant analogy from TD Bank. When frost blankets Florida, the supply of oranges drops, and the price of orange juice at the grocery store goes up. The information driving the price is totally obvious. But stock prices? They are much harder to decode. To really understand them, we need deeper corporate models, specifically the discounted cash flow model, which relies heavily on return on invested capital. So here is the absolute crux of corporate valuation. Step 1. A business generates profit. Step 2, to grow, it has to reinvest some of that profit. But if a company has a high return on invested capital, or ROIC, it's highly efficient. It doesn't need to reinvest much cash to grow. Step 3, that leaves a much larger pile of free cash flow to hand right back to you, the shareholder. Now, what's really interesting about this slide is the mathematical proof. Notice the top row, where companies are growing at 6%. If a company has a weak ROIC spread of just 1%, its fair PE is 12.2. But if another company has a highly efficient ROIC spread of 10%, its fair PE jumps up to 19.8. Even with the exact same growth rate, the highly efficient company demands a significantly higher PE multiple because it simply leaves more cash for the owners.
Okay, section 4, Shiller P, zooming out for the macro view.
So far, we've been laser-focused on single companies and single years. But let's zoom out to the full macroeconomic business cycle. Enter the Shiller PE, or the CAPE ratio, created by Nobel laureate Robert Shiller. Instead of just looking at last year's earnings, it looks at the average of the last 10 years, adjusted for inflation. It kind of acts as the grown-up in the room. By looking at a whole decade, it stops temporary earnings spikes or sudden recessions from making the broader market look artificially cheap or artificially expensive. Let's take a look at history. The long-term average for this ratio is around 17, but at major market peaks, it spikes. Ahead of Black Tuesday in 1929, it hit 32.5. The all-time record was 44.2 during the 2000 dot-com bubble. Fast forward to early 2026, driven by all that intense AI optimism, the Shiller PE crossed 39.85. Make no mistake, that is the second highest level in the entire history of the stock market. So, does this mean a crash is imminent tomorrow? Well, not necessarily. We need to look at this impartially. Critics of the Shiller PE argue that the world has fundamentally changed. They point out that modern accounting standards can actually artificially lower current earnings. Plus, massive corporate share buybacks skew the per-share data in ways the original model just didn't anticipate. And finally, historically lower interest rates often justify investors paying higher premiums for stocks rather than settling for bonds. Finally, Section 5. Putting it all together and building your valuation toolkit. We've peeled back the layers, from basic math all the way to macro theory. Now, let's build a practical system. So the crucial point is that no single metric is the holy grail. You need a holistic checklist. First, check the standard PE to assess the basic sticker price. Second, immediately contextualize that with the PEG ratio to evaluate the premium on growth. Third, pop the hood and dig into ROIC to confirm the underlying engine's true efficiency. And finally, zoom out with the Shiller PE to assess broader macro cycle risks. Now, if you find yourself in an environment where valuations just look totally stretched, the answer is rarely to panic sell or try to perfectly time a market crash. Instead, it's all about systematic risk management. Use strategic rebalancing. Take some profits from your overvalued winners and seek out relative value in overlooked sectors or global markets. That's how you manage risk. I want to leave you with a final, provocative thought to chew on today. Go take a look at your own holdings. Is the cheapest stock in your portfolio, the one with the lowest PE, actually a brilliant bargain? Or, knowing what you know now about growth and ROIC, is it just a value trap in disguise? Apply this new toolkit, and you might just see your investments in a completely different light. Thanks for joining me on this explainer. Keep learning and stay focused.